So 3.1 and 3.2 are basically going to be talking a bit about the same thing about income statement and revenue and expenses. So if you're following in our textbook for 3.1, it's page 72 to 80, so it's going to be quite quick. We're going to start talking a little bit about revenue and expenses. We've talked about assets, we've talked about liabilities and owner's equity. The last two that we haven't introduced yet are revenue and expenses. Revenue and expenses get reported on an income statement, whereas assets, liabilities, and owner's equity are reported on a balance sheet. So we're going to learn how to make one of those. We're going to talk about time period principle, matching principle, and accrual basis of accounting and cash basis of accounting. So that's where we're going with this lesson today. Okay, so profit and loss. The reason why your company is in business is to make money. When you make money, it's called a profit. Unfortunately, sometimes your business will also lose money. If you are making money, we're going to call that revenue. If you are using money to make money or to operate your business, we're going to call that expenses. Some types of expenses would be advertising, delivery, power, telephone, any kinds of things that your business operate. We're going to put those into expense accounts. And of course, your revenue minus your expenses will be your profit or your net income. If your revenue is higher, in this case, than your expenses, you have a net income. If your expenses are higher than your revenue, you have a net loss. We report our revenue and our expenses on an income statement, and we do this in an accounting period like you would do with your balance sheet. So if you do it every month, you would make an income statement and you would do a balance sheet. Then at the end of the year, you would do exactly the same thing. So a quick overview of what an income statement looks like. It has two major sections, well, three sections if you talk about the heading. The heading is the company name, what you're making an income statement, and for the time period that this income statement is going to cover. Okay, that's called the who, the what, and the when. The other two parts are the revenue section. And all you want to have here is you want to have your revenue subheading. Then you're going to list them in the first column with a single underline to show that you're adding. And this is your total revenue right here. And it goes in your second column, which is used to total. And you're going to use the word or the subheading total revenue. Right underneath it is going to be your subheading expenses. You're going to list all your expenses on the first column with a single underline to show that you are adding. Okay, and then your total is going to go here. Okay, I'm going to flip back so that you can see when it's all put together. So we've already talked about this. We've already talked about this. Now, you're going to use a single underline here to show that you're adding these two totals together to get your total here. Now that is either your net income or your net loss. Because your revenue is higher than your expenses, we have a net income, and we have to use the word net income. Okay, so you are subtracting these to get this total here with a double underline to show that your work is balanced. If your revenue were to be higher than your revenue would be lower than your expenses, then you would not use a negative sign, but you would use the word net loss over here. Okay, the word net loss signifies that you have lost money. Okay, so that is how you figure out your net income or your net loss. Just to cover a couple principles here, reminder that time principle, period principle means that you do the same thing consistently for every month. So if every month you're making a balance sheet and income statement, you have to continue to do that every month. Matching principle just means that if you are making money in one expenses for that are also recorded at that same time. Okay, had a little technical difficulty, had to stop there for a couple seconds. So this would be an example of an error in your matching principle. The chart below shows abbreviated sample income statements for July and June. The statements on the left were prepared with correct information. The statements on the right demonstrate the result of making an error. So what is happening here is it says an expense of $2,000 that was incurred in June was mistakenly recorded in July. So in June, it looks like everything is correct here with the $1,000, net income of $1,000. The incorrect way of putting it, though, is the $2,000, instead of being added in June, is put over into July. So do you see what happens? It looks like June you had an income of $3,000, and in July you had a loss of $1,000. But actually, it should be $1,000 on June and $1,000 of July. Okay, we don't talk a lot about this, but accrual basis of accounting just means that when your transaction is happening is when you record it into your account. Cash basis is when you don't record your accounting records until you're actually receiving cash. For accounting 10, we will be using accrual basis of accounting. Revenue recognition principle, same thing, just says that you are going, when you earn your money, when you're making your money is when you're going to record it into your accounting records. Okay, and I've already talked about cash basis of accounting, just means that you don't record it until you actually receive the cash. Which sometimes people take a while to pay their bill, so it's not really the most accurate basis of accounting. So we will be using accrual basis.